Greetings, and welcome to my video of my presentation of thesis proposal entitled "The Relationship Between Environment, Social, and Governance Performance and Firm Performance During the COVID-19 Pandemic: Evidence from Emerging Countries." I shall begin from the chapter 1, which is Introduction. I shall start from the research background. So environment, social governance, or ESG, or corporate social responsibility, have become the center of attention for investors. It has been considered economically important to the performance in investment. Previous literature showed that the effects of integrating corporate ESG behavior into investment practices and returns in finance have become an ethical or responsible investment structure. On the other hand, the state of the COVID-19 pandemic occurring at the end of 2019 is certainly affecting different sectors. This condition has been affecting all industries, including international travel, tourism, and hospitality. The impact of the COVID-19 pandemic economically and socially is unprecedented, with confirmed cases and deaths exceeding 8,437,000 worldwide in the second week of June 2020. The resilience of a company in the era of COVID-19 pandemic is a challenge that requires reliable management. Therefore, financial factors are elements that must be an important concern for companies to develop their organization. Next, I would like to talk about my first research question. ESG disclosure can provide important additional aspects exceeding financial information based on such practice. This finding is consistent with Goldstein and Yang 2015, who found that price informativeness can be improved throughout additional information diversification in the economy. However, it is uncertain whether firms would obtain an advantage from the cost savings in short or term or not. This is implying that the association between environmental and financial performance proxy can turn negative. A prior study by Van der Laan, Van Is, and Van Whitlow-Sugin suggested that 2008 suggested that there is a negative association between negative corporate social performance and short-term financial performance proxied by return on assets. Based on the background and formulation I mentioned earlier, the research question is as follows: what is the impact of ESG on firm performance in the long and short term? As for the research question number 2, or the second research question, a study by Fadhur et al. 2021 found that social enterprise crowdfunding faced great challenges during pandemic. Startups and small-scale businesses in China have a 60% decline in investments in equity in the first 3 months of 2020. There are concerns that ESGs are deprioritized by firms which are caused by them being faced with a financial crisis induced by the pandemic. However, the company's efforts have paid off by being more environmentally friendly and transparent about its sustainability activities in the environment caused by the pandemic. This is due to systematic risk being less exposed in environmentally responsible businesses. On the contrary, previous literature also found that after the markets fell in late February 2020, funds with low risks of ESG were much more preferred because these were seen as overhedging against market downturns by investors. The effect of the pandemic on such factors is generally uncertain and unknown, and therefore, contradictory findings have been reported in studies on ESG and ethical portfolio performance during the crisis caused by the COVID-19 pandemic. Based on the background and formulation above, the research question is as follows. Research question number 2, could COVID-19 affect the relationship between ESG and firm performance? I would like to go on to my theoretical contribution. First of all, I would like to talk about the theoretical contribution. This research could be a contribution to accounting science development on how ESG and COVID-19 can affect the state of a firm. As mentioned earlier in the problem's formulation, most research on topic of COVID-19 only studies its effect before and after the pandemic. This research takes a different approach by adopting new measurement of COVID-19 pandemic following the research by Hu and Zhang 2021 by measuring the severity of the COVID-19. Most previous studies also studied the effect of ESG in the settings of cross-country. However, most studies did not study this effect on the settings of emerging and G20 countries at the same time, which would be approached in this research. G20 countries are countries leading the global economies and are contributing global carbon emissions significantly. In addition, emerging markets are responsible for a substantial number of imports of goods and services from developed economies. Emerging markets are also investing at an increasing pace to keep up with the competition of developed markets. The global outcomes of ESG practices in the future are crucially affected by these markets. As for the practical contribution, for companies, this research could be a consideration for them in decision making and thus expected to increase more on their ESG performance. As for investors, this research could be a consideration for them so that their assessment of the companies they would be investing on will depend not only on profitability, but also on how they are responsible to their social surroundings. As for the regulation contribution, this research could be a contribution to regulators so that there would be a more binding regulations regarding how ESG should be disclosed. Next, I would like to move on to the second chapter, the theoretical foundation and the literature review. I would like to first talk about the theoretical review. First off, I would like to talk about the stakeholder theory, the theory that I will be referencing on. Countless studies have used stakeholder theory as a theoretical framework in ESG research. Stakeholder theory defines the association of an organization with its stakeholder. Sustainability disclosure, or in this context, ESG disclosure, is a way to communicate an organization's performance to the interests of various stakeholders. This is relevant to the company's goals of creating value for stakeholders. ESG has been considered a proxy that represents stakeholder social responsibility. This is because stakeholders could get evidence of how companies treat their stakeholders, manage operational impacts on the environment, and how companies implement good governance through ESG performance disclosure. So it is suggested that an escalation in ESG would expand financial performance for companies enjoying liquidity and flexibility. Based on this logic of thinking, stakeholders could increase their investments on a firm with a high ESG rate. This is because stakeholders view firms with sustainability having high ESG ratings as firms with the potential of gaining colossal profitability. Next, I would like to talk about my literature review. A review of literature by Fried et al. 2015 found about 90% of approximately 2,200 studies have a neutral or non-negative relationship, with a great amount of them showing positive results. Over time, results appear to be mostly positive and vary across portfolio and non-portfolio studies, regions, sectors, and asset classes. They also discussed that in the individual E, S, and G or ESG specific findings, there is inscrutability or mixed results in the literature they reviewed. This research will be studying the effects of ESG on firm performance on two complementary financial performance measures following a prior study by Siddiq et al. 2021, the short-term and the long-term measures. The financial performance in short-term measures examines the current performance of a firm, while the long-term measure emphasizes more on their future performance. Next, I would like to talk my hypothesis development. On first hypothesis, when companies decrease their GHG emissions rather than a pollution capture and remediation strategy, those companies are following a pollution prevention strategy. However, it is uncertain that firms would obtain an advantage on the cost savings in short term, implying that the association between environmental and financial performance proxy can turn negative. A prior study by Van der Laan, Van Is, and Van Wittel-Sugin, 2008, suggested that there is negative association between negative corporate social performance for primary stakeholders and short-term financial performance proxied by return on assets. Based on theoretical and prior literature I mentioned earlier, it is clear that most research are leaning towards negative results in ESG disclosure on the firm performance in short term. Therefore, I would like to propose a hypothesis as follows. Hypothesis 1, ESG performance has a negative impact on firm performance in short term. Second hypothesis development, accounting measurements such as return on assets and return on equity can cause a bias due to these measures can capture only the performance in short term for the firm. Therefore, Tobin's Q can be a good proxy for long-term financial performance. Other than recording the current performance of companies, Tobin's Q can also take into account their growth prospects in the future. Tobin's Q also includes intangible assets and investors' long-term view of a firm's sustainability. Furthermore, a study by Busk and Hoffman 2011 suggested that Tobin's Q depicts the market's perception of the competitiveness of firms in the business environment. Therefore, based on the theoretical and literature review I mentioned earlier, it is clear that most research are leaning towards positive results in ESG disclosure towards the firm performance in long term due to its prospects. Therefore, I would like to propose the second hypothesis: ESG performance has a positive impact on firm performance in long term. Third hypothesis: research is limited in the topic of definitive role of ESG activities in the times of crisis. However, observations have been drawn from the global financial crisis in 2008 to 2009, or I should call it GFC in short. Previous literature shows that US non-financial organizations with tall ESG ratings outperformed other firms during this period. A prior study by Rubani et al. 2021 also suggested that there is an extraordinary and positive call movement among the GFI and ESG determinants over the pandemic, in line with safe haven properties of ESG indicators during the COVID-19 pandemic. A study by Akhtaruzaman, Bobaker, Chia, and Zhang 2021 also implied that the COVID-19 pandemic affected the oil price risk vulnerability of both financial and non-financial companies. Based on the prior literature review I mentioned earlier, it is clear that most prior studies suggest that firms took a heavy toll caused by the COVID-19 pandemic, especially in their ESG and financial performance. Therefore, I would like to propose my third hypothesis: ESG performance impact on firm performance in the long term is associated with COVID-19 pandemic. Now we can move on to the third chapter, the research methodology. I would like to first talk about my sample of research. The sample of this research are firms from emerging countries included in G20 from the year 2020 to 2021. G20 countries are countries leading the global economies and are contributing global carbon emissions significantly, which will affect environment in the end. In addition, emerging markets are responsible for a substantial number of imports of goods and services from developed economies or developed countries. Next, I would like to talk my research models. In this research, multiple linear regression analysis is used to determine the effects between ESG score and the COVID-19 pandemic on firm performance in the short term and long term. These are the models used to test the hypothesis. And these are the description for each symbols used in the model. Next, I would like to talk the variables used on this research. First is the dependent variables. The dependent variable of this research is firm performance. There are two types of firm performance measurement: short-term and long-term. Return on asset, or ROA, is considered to be the short-term financial performance measurement, since this measurement considers current costs and relevant revenues disclosed in the financial statement to be immediately paid off for profitable investments. On the other hand, Tobin's Q is considered as the measurement for long-term performance. This measurement is considered because Tobin's Q includes intangible assets and an investor's long-term view of a firm's sustainability. The data can be obtained from Thomson Reuters and Osiris database. The formula for second one, I would like to talk about the independent variables. The main explanatory variable in this research is ESG performance, proxied by the ESG score obtained from Thomson Reuters. ESG disclosure is commonly voluntary and viewed as an expression of transparency and accountability. Thus, the ESG score reflects a firm's specific level of ESG disclosure. There are other independent variables as well, such as moderating variable and control variables. First, I would like to talk about the moderating variable first. The moderating variable for this research is COVID-19. This variable is measured by the logarithm of cumulative COVID-19 cases in each country the firm resides. This proxy is chosen due to its ability to measure the severity caused by the COVID-19 pandemic. The cumulative COVID-19 cases can be obtained from World Health Organization, or WHO. Next, I would like to talk about my control variables. There are two types of control variables. First one is the firm level control variables and country level control variables. This research includes several firm level control variables. They are firm size, leverage, capital intensity, growth, and beta. The data regarding these variables can be obtained from Thomson Reuters and Osiris. And the country level control variables is market cap, or I should say market capitalization. The data regarding this control variable can be obtained from Thomson Reuters and Osiris. And these are the formulation of each variables, as I would say, from return on assets, Tobin's Q, ESG performance, COVID-19, firm size, firm leverage, firm capital intensity, firm growth, firm beta, and market capitalization or market cap in this slide. That will be all my presentation. For this thesis proposal. If you have any question, please type it in the comments below. Thank you and greetings.